The South African Reserve Bank has decided to keep the repo rate at the record low 3.5%. This was announced today by the Reserve Bank Governor Lesetja Kganyago following the bank's Monetary Policy Committee first meeting of 2021 this week. Joining me now to talk about this is Chief Economist and Thought Leadership Executive at IQ Business, Sifiso Skenjana. Sifiso, good to have you with us. It was a 2-3 kind of situation yet again. 3 saying, well, let's stay put, while 2 say we need to cut. Was this the right decision in the context of what's happening currently?
Sure. I think we have lamented, over and over again that the Reserve Bank has tended to be quite conservative in its approach towards the role that it ought to play, I guess, also in creating some financial buffers for all economic agents in the context of our economy, talking about households as well as corporates who are in the borrowing markets. And I guess if you just follow the utterances, right, that historically it seemed like the primary focus point has always been, the inflation trajectory as a price stability mechanism. And when you hear also that, the primary driver of inflation that we've seen has been food inflation. We saw at the end of last year good rains, bumper harvest, and so we expect that the price path is certainly going to remain particularly muted, which means that we don't expect any inflation coming into the system because, of course, there's also demand side pressures because the economy is not growing. And so the pressure point around then the inflation trajectory is certainly, I think, not a big risk item right now. And technically, they probably should have, taken a little bit more of an accommodative stance and looked at a 25 basis points cut.
Now, considering that, of course, we have seen, 300 basis points cut in a very short space of time, keeping it steady at 3.5, who does it help?
The interesting thing also, the governor, continued to lament on the fact that the secondary effects of the interest rate cuts often takes about 12 to 18 months for it to come into the real economy. And so in their view is that we haven't seen the full effect of that 300 basis points actually come through the rest of the economy. I'd certainly, based on all of the data points that we are observing, I would probably disagree because we are seeing a lot of the primary leading indicators continuing to worsen, and we are 12 months since the rate hiking cycle began. And we ask and say, well, who does it benefit? Of course, I think it's primarily corporates on the one side who are in the borrowing markets, as well as some of the higher earning individuals in South Africa who do have mortgage bonds, etc. We saw TransUnion numbers come out in October showing a 400 basis point increase in delinquency rates in terms of people paying back their home loans, which really talks to the extent to which those households as well are under immense amount of pressure and their ability to pay back their loans. And so those people are the ones who are primary, I'd call it beneficiaries, and then they're probably indirect beneficiaries because of the fact that there's some sense of trickle-down economics, if we can call it that way, where one corporate has a bit of financial reprieve, they may be able to help stimulate some economic activity elsewhere that could benefit people who aren't in the borrowing market. But for the most part, it is largely corporates as well as those who are on long-term borrowing assets like home loans.
Of course, if you are in real estate, in the property space, you would have wanted the Reserve Bank to cut at least by another 100 basis points, particularly because those in the property sector will tell you they saw a lot of activity around those who buy houses of about 1.8 million and lower. And this would have been a perfect opportunity for them to see some kind of movement.
Yeah, but also, in the purchasing basket from about 1.8 million all the way to about 3 million, we're seeing houses being sold at discounts of about from anywhere between 18 and 45%, particularly in the auction markets. And so again, the interesting thing around the data is that about 40% of home loan purchases in the last 18 months have been first-time buyers, and so it would be in the bracket that you are talking about, which would absolutely make it a lot more affordable for people to get into that asset purchase space. But again, even in the context of that, there's always a need for people to be a little bit cautious that when we see interest rates at record lows, you've then got to price in that in the medium to long term, you're going to be, paying bond at higher rates, as well as then being very mindful of the valuation of the property itself, because, there might not be a secondary market for that property, and you might eventually end up having to sell it at a loss. And so those are all the considerations as well that potential or prospective first-time home buyers would need to consider when looking at that interesting, kind of purchasing range from about 1 million to about 1.8, as you pointed out, Thabo.
Right. Looking at the inflation itself, you already mentioned that the Reserve Bank is worried about inflation. It is at its lowest now it's ever been, but we're continuing to see food prices rising, largely because it seems there's passed down inflation that comes from, for example, the producers who are sitting at a higher inflation, passing that on to the retailers, who then essentially then pass it on to the consumers. How do we rectify that?
Yeah, well, I mean, so I think it was also inflationary effects that came through during the course of last year. If you remember, there was foot and mouth disease in the context of that particular market, and therefore we saw meat prices being one of the largest contributors to the food inflation basket increasing, as well as non-alcoholic beverages. We understand, of course, there's the sugar tax, that is also imposed over and above those sugary drinks. And so those have actually been the primary drivers, including grain, because, of course, there had been constraints in that. But when we see then that what happened towards the end of the year, as I said, is that there was good rains, there was bumper harvest, we expect then that that's certainly going to be accommodative. I mean, for citrus, we saw in the last quarter of the year exports increasing by as much as 17%. We saw even wine exports, even despite the lockdown, also being up. I think it was about 7 or 8%. And so we've had record exports in the last quarter of the year because of, I think, the more accommodative agricultural context that we find ourselves in. And then that should have a pass-through effect for consumers, and therefore the food inflation as a primary contributor to the growing inflation will certainly become a smaller component in terms of contributing to high inflation. And then, as we said, is that households are under a lot of pressure, and so there's not going to be any pressure from the demand side of inflation. I think the Reserve Bank governor made a point, however, around oil prices, and we've seen those, how they've gone from about $38 per barrel in October to now about 68, and that's quite an increase, and we're seeing that coming through fuel prices, etc. And so that's probably going to be one of the things that is a point of pressure from an inflation point of view. But because the South African rand and our long-term bonds are one of the highest priced in the market, it means that it's probably going to be risk on for emerging markets, and there's going to be some foreign interest for the South African bonds, as well as that should be supportive for our currency, and we expect that our currency in the medium term should have prospects of strengthening a little.
The Reserve Bank governor saying the vaccine rollout, COVID-19 vaccine rollout, will certainly be good for the economy as compared to, I suppose, the cost, saying, well, it will cost something, but the cost of people coming back into the economy and actually being active far surpasses the cost that we will initially spend for those vaccines.
No, absolutely. I mean, and one of the kind of interest theories that we've spent a lot of time focusing on is Paul Romer's endogenous growth theory, which in essence really speaks to the role of the human capital investment in driving long-term aggregate output growth for the economy. And so the human at the center is one of our biggest investments, one of our biggest assets, rather, that we've got to make sure that we preserve, and of course we then position them for the right kind of growth to be able to be productive economic agents. So when you don't have a productive economic force because there's health pressure points and poor health resilience in the economy, that does in the medium term result in actually worse economic outcomes. And so any fiscal pressure point because of the procurement of the vaccine right now will far, or the benefit of the vaccine will far outweigh the fiscal cost that it may bring right now, because of the impact it will have in terms of improving health outcomes and therefore our human development index, as well as then that as a function of long-term economic growth. And so it certainly is just a small price to pay today to make sure that we've got a labor force that is functional and productive in the medium to long term.
Is there headroom for the Reserve Bank to cut? I mean, if you were the Reserve Bank governor, would you have cut, considering what's happening elsewhere throughout the globe?
Yeah, I mean, the Reserve Bank often goes back to their mandate, right? They say price stability in the context of sustainable economic growth, right? And therefore, a lot of the variables of interest is the inflation trajectory, is the economic growth outlook, as well as what's happening in the global markets, right? We're seeing in the US and other developed markets that the monetary policy stance remains accommodative. We're seeing that from an economic growth point of view, we're going to get increasingly more pressure from, a lower economic growth. And we're seeing that inflation is not going to be a risk item from a price stability point of view. And when you look at that in balance, it certainly means that there is scope for a further rate cut. And as I said earlier, right, that our long-term bonds are in excess of 9%, higher than a lot of the emerging markets, which means that the investors who are seekers of what for carry trade, or the yield seekers, would still find the South African market quite interesting because of that, despite a 25 basis points, for example, cut in the interest rates. We see in that forex market, 84% of the traders of our local currency are foreigners, which means that there still really is appetite because of the interest rate differential that exists there. So all of that, I think, on balance, certainly suggests that there is scope for the Reserve Bank to be a little bit more accommodative. And I think there is a little bit of scope for 25 basis points.
Chief Economist and Thought Leadership Executive at IQ Business, Sifiso Skenjana, appreciate your time and thank you very much for joining us tonight on the Newsfeed Late.